If you live in the United States, if you have a 401k, if your savings are tied up in stocks, bonds, or real estate, then the next few minutes are critically important for you. Because today, we are going to talk about something your financial advisor will never explain to you. Something that never makes it into the CNBC headlines. And a truth Wall Street desperately hopes you never fully understand. Today, the markets are closed, the ticker tape has stopped, and the final price on the screen is flashing one number, $71.91. At first glance, it looks like just another price, just another data point, but in reality, this number may be one of the most important warning signals in modern American financial history. For the first time in weeks, we have a moment of silence, a moment to step away from the noise of daily trading, the constant alerts, the rumors, and the chaos of intraday charts, and ask a far more dangerous question. Where are we actually headed? And when we look in that direction, what comes into focus is a picture that terrifies some and electrifies others. Silver at $71 feels wrong to a generation of Americans who grew up watching it trade at $15, $18, or $20. It feels like a mistake, like a bubble, like an unsustainable spike that must collapse. You look at your portfolio and feel a sense of vertigo. You tell yourself, it's already gone up too much. It has to come back down. That belief, right there, is the psychological trap most American investors are now stuck in. Because your mind is calibrated to an America that no longer exists. You are measuring value in dollars, whose purchasing power is being destroyed year after year. The reality is this: silver at $71.91 is not expensive. By historical standards, it remains one of the cheapest strategic assets on the planet. Over the next hour, we are going to walk backward through American financial history, back to 1980, then forward to 2011, and perform a forensic autopsy on the purchasing power of the US dollar itself. When this analysis is complete, you will understand why $71 is not a top. It is a floor. It is the foundation on which the next phase of the system is being built. What is happening right now is not a repeat of the Hunt Brothers episode. It is something far larger, far deeper, and far more dangerous to the American financial system. This is not a bubble. This is a repricing of reality. To understand that, we must return to the winter of 1979, when inflation was out of control, confidence in the dollar was collapsing, oil prices were exploding, and trust in the U.S. government was at historic lows. If that sounds familiar, it should, because history does not repeat. But it rhymes. In that climate of fear, three brothers from Texas recognized the weakness in paper money and chose silver as protection, a decision that still haunts the psychology of American investors 45 years later. What the history books rarely tell you is that the $50 silver price of 1980 is not the same as $50 today. Adjusted for inflation, that $50 is equivalent to roughly $175 in today's dollars. That means silver at $71 is trading nearly 60% below its true historical high. If Amazon stock, Apple shares, or U.S. real estate were trading at a 60% discount to fair value, Americans would be lining up to buy. But because it is silver, and because the trauma of 1980 still lingers, fear dominates the narrative. And in every era of financial history, that fear has always marked the greatest opportunity. Now understand the fundamental difference between 1980 and 2025. In 1980, the global population was approximately 4.4 billion people. Today, it exceeds 8 billion. The number of consumers has nearly doubled, yet the supply of silver has not. Global mine production has stagnated over the past decade. At the same time, the nature of demand has completely transformed. In 1980, silver's primary industrial use was photography, an industry that was price-sensitive and highly recyclable. When prices rose, demand fell and supply increased. Today, silver is embedded at the core of America's energy policy, the electric vehicle revolution, solar infrastructure, 5G networks, artificial intelligence data centers, and advanced military systems. These industries are not price-sensitive. If silver rises to $150, $300, or even $500 an ounce, they will not stop buying, because silver is not a cost to them. It is a necessity. This is the industrial trap modern civilization has built for itself. The above-ground stockpiles that crushed prices in 1980 no longer exist. They were consumed over decades and dispersed into electronics, where recovery is nearly impossible. This rally is not driven by leverage or speculation, but by a genuine physical shortage. Central banks, sovereign wealth funds, and industrial giants are paying cash and taking delivery. Meanwhile, the U.S. money supply has expanded 14-fold since 1980, while silver's supply has not. The gold-to-silver ratio continues to signal that silver remains historically undervalued. Add to this the pressures of de-dollarization, geopolitical conflict, and the global return to hard assets, and every vector points in the same direction. Higher. $71.91 is not a destination. It is a launch pad. The market may be closed today, but the forces driving this repricing never sleep. When trading resumes, the game continues, and those who understand this full picture are already holding the advantage.